When a corporation has a flawless credit rating, they can borrow money at low interest rates. But when their balance sheet is shaky, they have to pay a premium. This is the core of a credit risk fund. You lend your capital to these lower-rated companies in exchange for a much higher interest rate. In 2018, the industry saw exactly how dangerous that exchange can be. The ILFS crisis triggered a liquidity crunch that led to high-profile defaults from issuers like DHFL and Yes Bank, causing immediate losses for investors who thought they were in a safe debt product. The fallout lasted for 52 consecutive months. This chart shows the scale of that exit, as investors pulled more than 15,000 crore rupees out of the category, fearing that the entire sector had become too toxic to touch. The extra yield simply didn't justify the math anymore. Investors realized that a 2 or 3% bonus in interest was worthless if the underlying company defaulted on the entire principal. But by July of 2026, the data is showing a sharp recovery. Leading the pack is a massive statistical outlier, the Bank of India Credit Risk Fund. Over the last 5 years, this fund has delivered a return of 27.8%. It's a figure that stands far above the category average and its closest competitors. However, looking at the broader recovery reveals a deceptive trend. Some competitors are reporting high yields not through consistent performance, but through a mechanism known as the double-digit trap. These traps happen when a fund holds a bad bond that everyone has written off. If that bond miraculously pays out, the fund's value can spike by 11% in a single day. If you remove that one-off recovery, the fund's actual performance often drops to the bottom of the rankings. It looks like growth, but it's actually a one-time lottery win. Relying on the sudden repayment of distressed debt isn't a strategy you can rely on for long-term compounding. This raises a question. How is the Bank of India Fund sustaining its lead without relying on these lottery payouts? The secret is in how they manage their cash. While most credit risk funds lock their money into long-term corporate bonds, Bank of India keeps nearly 24% of its portfolio in repos. A repo is a short-term agreement that acts as a highly liquid cash equivalent. It serves as a shock absorber, giving the fund manager a massive pool of ready capital that isn't tied up in risky corporate debt. Most competitors are forced to sell their holdings at a loss if investors start withdrawing money. This liquidity buffer prevents that, allowing Bank of India to stay stable while others are forced into fire sales. Because they have that cash shield, they can be much more aggressive with the rest of their money. They have concentrated 62% of their holdings into just 2 specific areas: materials and financials. They've placed massive bets on the construction sector, with heavy allocations to companies like Nuvoco Vistas and Birla Corporation. It's a unique structure, an aggressive offensive strategy powered by a massive defensive cash reserve. We saw this exact strategy work in real time, holding firm during the severe market correction that hit in late 2025. Even as the broader market stumbled, Bank of India's maximum drop was only 11%, a much shallower decline than its peers. Because of that repo buffer, they recovered quickly. It took the fund only 46 days to climb back to its previous peak and start making new gains. This efficiency shows up in their Sharpe ratio of 0.95. In simple terms, they are generating nearly 1 full unit of return for every unit of risk they take. In a category where most funds struggle to manage the volatility of low-rated bonds, these numbers suggest their success is built on risk management rather than luck. Looking at the macro environment in July 2026, the landscape for corporate debt has changed. Interest rates are higher, and the market is scrutinizing corporate balance sheets more closely than ever. Chasing a high yield is no longer as simple as picking the fund with the biggest number on the fact sheet. Investors are now seeing that those top-line returns often hide significant liquidity problems. The Bank of India Fund has provided a template for how to manage these specific conditions, using high cash reserves to mitigate the inherent dangers of low-rated bonds. The real lesson here is a bit of a contradiction. To succeed in a category that is defined by taking risks, a manager's most important job is actually capital preservation. This is a signal to look past the marketing and check the actual mechanics of your DEF holdings. Are you seeing consistent growth or just a series of lucky recoveries? Long-term outperformance isn't about finding a single bond that pays out against the odds. It's about building a portfolio that is durable enough to survive the downturns so that it is still there to grow when the market recovers.